Welcome back to the channel, where we break down the complex world of finance, economics, and global markets into clear, understandable insights. Today, we're diving into one of the most pressing questions in the financial world: how the economic shifts in China could impact not just its own growth but the entire global economy. From slowing growth rates and property market challenges to debt concerns and ripple effects across global markets, we'll explore the facts, analyze the risks, and uncover what you need to know to stay informed in this interconnected world. So grab a notebook, settle in, and let's unpack what's really happening behind the headlines. China's economy has been showing signs of a quiet but significant slowdown, a reality that is often masked by the headline growth numbers that the country continues to report. On the surface, GDP figures may still look respectable, but a deeper look into the data reveals underlying weaknesses in multiple sectors, signaling that the engine driving China's rapid expansion for decades may be losing some of its momentum. One of the most visible areas of concern is the property sector, which has long been a cornerstone of China's economic growth. For years, property development fueled employment, consumer spending, and local government revenue. However, in recent times, major property developers have faced financial stress, with defaults and stalled projects becoming increasingly common. This slowdown in construction and real estate activity is not just a sector-specific issue. It has cascading effects on industries ranging from steel and cement production to household appliances and furniture, which are heavily linked to new housing demand. Additionally, consumer confidence has been impacted. Many Chinese households invested heavily in property, seeing it as both an asset and a form of savings. When property values stagnate or decline, this affects spending patterns, as people feel less wealthy and more cautious about taking on debt or making significant purchases. Beyond real estate, industrial production has shown signs of weakness. Factories are experiencing slower order volumes, reflecting both domestic demand shifts and global market fluctuations. Exports, while still substantial, are facing headwinds due to a combination of international competition, changing supply chains, and geopolitical tensions that impact trade agreements and tariffs. Investment in innovation and technology, often touted as the new growth engine for China, has also seen mixed results. While certain tech sectors continue to expand, regulatory crackdowns on fintech and other tech giants in recent years have created uncertainty, affecting investment appetite and slowing down the pace of digital transformation in certain areas. Government stimulus measures, which in the past were able to revitalize the economy during slow periods, are showing diminishing returns. Traditional tools like interest rate cuts, tax incentives, and infrastructure spending are still being employed, but their effectiveness is limited when underlying issues such as high debt levels, overcapacity in certain industries, and demographic pressures persist. China's demographic challenges, including an aging population and declining birth rates, are starting to manifest more clearly, influencing the labor force and long-term productivity. The combination of slower economic activity in critical sectors, cautious consumer behavior, industrial production challenges, and demographic constraints all point to an economy that is struggling to maintain the rapid growth rates seen in previous decades. This slowdown has implications beyond China itself. As one of the largest economies in the world, any reduction in growth can influence global supply chains, commodity prices, and international markets that are closely tied to Chinese demand. The ripple effects are particularly noticeable in countries heavily reliant on Chinese imports or exports, as well as in financial markets that are sensitive to changes in growth expectations. Understanding the subtle signs of this slowdown is crucial for investors, policymakers, and analysts. While the headline numbers may still appear strong, the structural issues beneath the surface suggest that the Chinese economy is at a critical juncture, needing careful management and strategic planning to navigate these complex challenges and maintain stability in a rapidly changing global landscape. The risks emerging within China's economy are not confined to domestic boundaries. They carry the potential to ripple across the global financial system in profound ways. When an economy of China's scale begins to falter, the consequences extend far beyond its own borders, affecting trade, investment, and market confidence worldwide. One of the primary ways these structural risks manifest is through the interconnectedness of global supply chains. China serves as a manufacturing hub for countless industries, producing everything from electronics and machinery to textiles and consumer goods. A slowdown in production or disruptions caused by financial instability in key sectors can trigger shortages, delays, and increased costs for companies around the world. Businesses that rely on Chinese manufacturing may find themselves grappling with delayed shipments, e-gear prices, or the need to seek alternative suppliers, all of which can impact profitability and planning. Another significant channel for global impact is the financial sector. China's banking system, while large, has pockets of vulnerability, particularly related to local government debt and loans extended to struggling property developers. If defaults increase or banks face liquidity pressures, there is the potential for these problems to spill over into international markets through investment holdings, cross-border lending, or global investors who have exposure to Chinese debt instruments. Even though China has historically maintained capital controls to limit direct exposure, the integration of financial markets over the past decades means that shocks are increasingly capable of reverberating across continents. Commodity markets are also highly sensitive to changes in Chinese demand. China is the world's largest consumer of metals, oil, and other raw materials, and a slowdown in industrial production can sharply reduce consumption. This has immediate implications for exporting nations, particularly resource-rich countries whose economic stability is linked to steady demand from China. For example, falling steel or copper purchases can lead to price declines, impacting government revenues, corporate profits, and investor sentiment in those countries. The effect extends to global stock markets as well. Investor sentiment is often influenced by economic performance in major economies, and signs of stress in China can create uncertainty and risk aversion among global investors. Equity markets may react to fears of reduced earnings, declining exports, or potential financial instability, leading to broader market volatility. Additionally, the interconnected nature of multinational corporations means that even companies based outside China can be affected if their operations, supply chains, or customer base depend on the Chinese market. Geopolitical factors further complicate the picture. Trade tensions, tariffs, and diplomatic friction between China and other major economies can exacerbate the effects of domestic slowdowns. Reduced confidence in China's economic stability can accelerate shifts in trade patterns, investment decisions, and currency valuations, all of which feed back into global financial conditions. Beyond the immediate financial and trade impacts, there is a psychological dimension to consider. Global investors and policymakers often react not just to actual economic data but to perceived risks. Reports of financial stress, debt issues, or property market crises can lead to heightened caution, reduced investment, and capital flight, amplifying the very problems that are being observed in China. Understanding the global reach of China's structural risks is therefore essential. It is not sufficient to view these challenges as isolated domestic issues. They represent potential triggers for broader economic instability, making careful monitoring and strategic planning crucial for governments, corporations, and investors. One of the most concerning aspects of China's current economic situation is that the traditional tools historically used to stimulate growth are showing diminishing returns. For decades, China has relied on a combination of government-led stimulus measures, infrastructure investment, and monetary policy adjustments to manage slowdowns and maintain steady expansion. In previous cycles, these tools were remarkably effective. Lowering interest rates could spur borrowing and spending. Tax incentives would boost corporate investment, and large-scale infrastructure projects provided both employment and demand for materials. However, the current economic environment presents challenges that are fundamentally different from those of the past. Interest rates are already relatively low, leaving less room for further cuts to meaningfully stimulate borrowing and consumption. At the same time, corporate debt levels remain high, particularly in sectors like real estate and construction, which means that even if loans are available at attractive rates, many companies are reluctant or unable to take on additional debt without risking insolvency. Fiscal stimulus, another traditional lever, is similarly constrained. Local governments, which have historically been key drivers of infrastructure spending, faced budgetary pressures due to declining revenues, particularly from land sales and property-related taxes. This limits their ability to inject significant funds into new projects. And even when spending occurs, the impact on long-term economic growth is muted if it merely replaces private sector activity rather than creating net new demand. The real estate sector, once the engine of growth, illustrates the limits of traditional stimulus. Government interventions, such as easing borrowing rules or offering support to developers, have had uneven success. Many property developers remain burdened with unsustainable debt, and consumer confidence in the housing market has been eroded by delays, defaults, and falling property values. As a result, measures intended to stabilize the market often produce only temporary relief without addressing underlying structural issues. Beyond financial tools, demographic factors further reduce the effectiveness of stimulus. China's aging population and declining birth rate mean that the labor force is gradually shrinking, which limits productivity growth and reduces the multiplier effect of investment. Even with aggressive fiscal or monetary interventions, the long-term potential for growth is inherently constrained by these demographic realities. The regulatory environment also plays a role. In recent years, crackdowns on major tech companies, financial platforms, and other industries have introduced uncertainty that dampens private sector investment. Businesses and investors are now more cautious, which diminishes the expected boost from government-led initiatives. This combination of high corporate debt, demographic headwinds, constrained fiscal capacity, and regulatory uncertainty suggests that traditional levers, while still in use, may no longer be sufficient to drive the level of economic growth China has experienced in the past. Policymakers face a delicate balancing act, using stimulus without exacerbating debt issues, encouraging spending without fueling speculative bubbles, and fostering confidence in sectors that are structurally weaker. The situation highlights the complexity of managing a modern, interconnected economy, where old solutions may no longer yield the same results. It also underscores the importance of strategic planning and innovative approaches to policy. China's economy does not operate in isolation, and one of the most critical aspects of its current slowdown is the impact it can have on global markets. The world has become deeply interconnected, and China's role as a major consumer, manufacturer, and investor means that any significant shifts in its economic performance are quickly felt across borders. Global trade is perhaps the most immediate channel through which China's slowdown reverberates internationally. As one of the largest exporters and importers in the world, China drives demand for raw materials, components, and finished goods. A reduction in manufacturing activity or industrial output can lead to lower imports of commodities such as oil, metals, and agricultural products, which directly affects the economies of countries that rely on exporting these resources. Conversely, nations that depend on exporting high-tech products or machinery to China may face declining revenues if Chinese demand softens, creating a ripple effect that extends to employment, corporate profits, and government revenues abroad. Supply chains are another key factor amplifying China's influence. Modern production processes are highly globalized, with components and parts moving across multiple countries before reaching the final consumer. A slowdown in China, particularly in manufacturing hubs or ports, can disrupt these supply chains, causing delays, shortages, and cost increases for companies worldwide. For multinational corporations, this can translate into delayed product launches, higher operating costs, and the need to find alternative suppliers, all of which can impact their competitiveness and financial performance. Financial markets are equally sensitive to changes in China's economic trajectory. Investors worldwide monitor China's growth indicators closely, and even subtle signs of stress can trigger market volatility. Equity markets may respond to fears of lower earnings for companies dependent on Chinese consumers or industrial activity, while bond markets might react to concerns over debt sustainability in Chinese corporations or local governments. Currency markets are also affected, as investors recalibrate expectations for the yuan and other related currencies, influencing global capital flows. Another channel through which China's slowdown can influence global markets is through investor sentiment. Perceptions of economic instability, particularly in a major economy, can heighten risk aversion among global investors. This often leads to capital flight from emerging markets, reduced investment in riskier assets, and a flight to safety in assets like U.S. Treasuries or gold. The psychological impact of uncertainty can amplify the material effects of the slowdown, creating a feedback loop that intensifies volatility and risk perception worldwide. Geopolitical considerations further magnify the effects. Trade disputes, sanctions, and diplomatic tensions can exacerbate the consequences of a domestic slowdown, leading to more pronounced impacts on global commerce and investment decisions. For countries heavily integrated into the Chinese economy, these factors compound the challenges, making careful monitoring and risk management essential. Understanding the global implications of China's economic performance is therefore critical for policymakers, investors, and corporations alike. A slowdown in the world's second-largest economy is not merely a local concern. It has the potential to affect everything from commodity prices and corporate profitability to market confidence and cross-border investment strategies. In an interconnected financial ecosystem, what happens in China rarely stays in China, and the ripple effects can influence economic stability, market performance, and policy decisions around the world. Recognizing these interconnections allows stakeholders to anticipate potential disruptions, adjust strategies, and respond proactively to shifts that might otherwise catch them off guard. One of the most critical warning signs of potential financial instability in China lies in the rising levels of debt and the persistent deflationary pressures across various sectors. Debt accumulation has been a defining feature of China's economic growth model for decades. Corporations, local governments, and even households have relied heavily on borrowing to fund expansion, real estate development, infrastructure projects, and consumption. While this model fueled rapid economic growth in the past, it has also created vulnerabilities. In the current environment, debt levels are straining balance sheets, particularly in industries that are slowing down or facing structural challenges. Property developers are a primary example, with many companies saddled with significant liabilities that they struggle to service due to declining sales and stalled projects. This situation has a cascading effect on suppliers, financial institutions, and investors, creating pockets of stress that could escalate if not managed carefully. Local government debt is another concern. Chinese municipalities have historically relied on land sales and infrastructure investment to fund operations. But with the property market cooling and revenue streams under pressure, many local authorities are increasingly dependent on borrowing. This combination of high debt and limited cash flow reduces flexibility, making it more difficult to respond effectively to economic shocks or implement stimulus measures that are traditionally used to stabilize growth. Deflationary pressures compound the risk. When prices across goods and services stagnate or decline, businesses face lower profit margins, which can discourage investment and expansion. Consumers, anticipating further price drops, may delay purchases, reducing demand and further weakening economic activity. This creates a feedback loop that can be difficult to break, especially when coupled with high debt, as both companies and governments have fewer resources to counteract the slowdown. The interplay between debt and deflation is particularly dangerous because it can undermine confidence in the financial system. Investors and lenders may become hesitant to extend credit, fearing defaults or further declines in asset values, which in turn tightens liquidity and amplifies stress in key sectors. Even sectors not directly affected by debt issues can feel the ripple effects, as reduced spending and investment dampen growth across the broader economy. On a global scale, the implications of these internal pressures are significant. China's economy is deeply integrated into international trade and finance, meaning that stress within its banking system, corporate sector, or property markets can influence foreign markets, investment flows, and commodity prices. Investors worldwide monitor Chinese debt levels and deflationary trends closely because any deterioration can affect global risk sentiment, asset valuations, and economic forecasts. The government is aware of these risks and has implemented measures to mitigate them, including targeted support for struggling developers, regulatory adjustments, and monetary interventions aimed at maintaining liquidity. However, the scale of the challenges, coupled with structural issues such as demographic shifts, rising labor costs, and slowing productivity growth, means that these measures may only provide temporary relief rather than a long-term solution. Recognizing and monitoring these warning signs is crucial for policymakers, investors, and analysts who seek to understand the potential for broader financial instability. Debt and deflation are interconnected challenges that can magnify vulnerabilities, and their presence in a major economy like China underscores the importance of caution and strategic planning. By paying attention to these indicators, stakeholders can better anticipate potential disruptions. In summary, China's economic landscape is facing a combination of slow growth, structural risks, and mounting financial pressures that have implications far beyond its own borders. The slowdown in key sectors like real estate and industrial production highlights underlying vulnerabilities, While traditional stimulus tools are proving less effective than in the past, these domestic challenges are deeply interconnected with global markets, meaning that disruptions in China can ripple across trade, investment, and financial systems worldwide. Rising debt levels and deflationary pressures further amplify the risks, creating a situation that requires careful monitoring, strategic policymaking, and a nuanced understanding of global interdependencies. For investors, analysts, and policymakers, the key takeaway is that the headlines alone don't tell the full story. A thorough examination of the structural